I think we're ready to go if you guys are ready to go. You standing, getting courage, is that what we're trying to do? But thank you for coming. Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Opportunities and Challenges Facing the National Flood Insurance Program. I'd like to thank the witnesses for appearing today. We'll look forward to your testimony. I now recognize myself for 3 minutes to give an opening statement. My district is home to many communities that lie in floodplains near major rivers, streams, and lakes. Many of the towns I represent, like so many communities across the nation, are suffering from some of the most destructive floods seen in years. While the long-term repercussions are yet to be fully known, previous experience has continually brought to light many issues surrounding the National Flood Insurance Program. Within the past 5 years, nearly every one of the 50 states has experienced flooding. In the past decade, insurance claims stemming from flood damage have averaged $3.5 billion a year. It's not surprising then that flooding is the #1 natural disaster in the United States. As a result, the NFIP today has an outstanding debt of approximately $23 billion borrowed from the Treasury, with $7.45 billion remaining of its total temporary borrowing authority. I previously voiced concerns about the administration, operation, and suitability of the NFIP. Time and time again, we've seen Americans suffer because of governmental failure and inaction in times of greatest need. Authorization of the NFIP will expire on September 30th, 2017. Unlike in previous years, it's my hope that Congress can avoid coverage lapses that leave economies along the Missouri-Mississippi rivers and local economies in every congressional district in a lurch. At the same time, we all recognize, regardless of political affiliation, that the status quo isn't acceptable. Throughout this year, this committee will aim to garner more information on the NFIP, examine whether or not changes to flood insurance are likely to solve long-standing issues, and develop ways to fix a broken system in order to ensure it does more to benefit all parties involved. I look forward to today's testimony and to the start of what I hope is a productive conversation on the future of flood insurance in America. My hope is that at some point over the course of this year, we'll be able to get enough information put together that we can put together the reauthorization bill by the end of the year, and that will take next year, 17, to be able then to authorize that bill, fine-tune it, and get it to the point where we can pass it and avoid the management by crisis that we do around here on a regular basis. However, that being said, I look forward to today's testimony, and with that, the chair now recognizes the ranking member of the subcommittee, the gentleman from Missouri, and my good friend, Mr. Cleaver, for 5 minutes for an opening statement.
Thank you, Mr. Chairman, and members of the subcommittee, as well as the witnesses today, especially Tom Wood, who Wood Custom Homes is one of the most significant and successful builders in our area. And Tom Woods, of course, served as mayor of Blue Springs probably 10 years before I served as mayor of Kansas City. I'm so pleased that he is here. And he knows, as well as people in the state of Missouri, as you've already indicated, Mr. Chairman, this is a significant issue that we're dealing with, and this hearing is particularly appropriate. In the last few weeks, flooding from the Mississippi River has damaged homes and businesses in Missouri. Now, my congressional district was spared much of the damage to homes and businesses that hit the western and southwestern part of our state. Closer to home, I do often hear from farmers in my district who remain extremely concerned over flooding risk in their fields. As we all know, the National Flood Insurance Program was created in 1968 through the passage of the National Flood Insurance Act in response to a limited number of available companies who were private companies who were interested in providing flood insurance. The NFIP provides flood insurance to many property owners in designated areas, as well develops the flood insurance rate maps and promotes mitigation activities. Since 1968, the Act of NFIP has been amended many times, more recently through what we all affectionately call the Biggert-Waters Act of 2012 and the Homeowner Flood Insurance Affordability Act of 2014. With the need for authorization around the corner, today we have the opportunity to fully discuss this issue, and more specifically, it gives us a chance to consider the importance of retaining flood insurance, as well as how we can improve this program. I'm going to be the last person to ever say that the issues we deal with federal agencies are perfect. They are imperfect. The only thing perfect is the 11 consecutive games won by the Kansas City Chiefs. I look forward, Mr. Chairman, to this hearing, and now I would ask if the ranking member, Ms. Waters, would take the remainder of my time.
Very good. Good morning, ranking member, whenever you're ready. Okay. Ranking member of the entire committee, Ms. Waters from California, is recognized for 2 minutes.
Thank you very much, Mr. Chairman. I'm pleased to see that this committee has chosen to prioritize the National Flood Insurance Program this year. At the end of last year, I requested that the committee hold this hearing because I believe that it is absolutely critical that we start thinking about the program and how we can improve it for the long term. Now, let me briefly discuss the beginning before we discuss the future. When I agreed to work with Ms. Biggard on what ultimately became the Biggard-Waters Act, our goal was to create a bipartisan solution to repair our ailing flood insurance program. There was a broad consensus around the need for the program because it is essential to our housing market and to our disaster recovery. For years, instability and insolvency issues threatened the effectiveness of NFIP, and since 2008, Congress has been extending the program a few months at a time. Twice, this led to shutdowns, including one that stalled more than 40,000 home sales in June 2010 alone. Short-term extensions caused lapse in the program that placed communities at risk and undermined our housing market. In 2010, the National Association of Realtors estimated that approximately 1,400 home closings were adversely affected each day the program set expired. For this reason, and to address the NFIP's then $24 billion debt, we attempted to fix the program through a 5-year extension and a 10-year repayment plan. But it soon became clear that our best intentions fell victim to circumstances that led to rate increases too severe for any family's budget. Together, we worked tirelessly to enact reform that provided much-needed rate relief for thousands of homeowners and put FEMA back on the path to addressing affordability issues on a broader scale. In 2013, when this committee refused to hold hearings, I convened a bipartisan meeting and led the creation of a bipartisan and bicameral coalition. Ultimately, we were successful in passing legislation that addressed the unintended consequences of the Biggard-Waters Act. I stand ready to take these next 2 years to continue in that spirit and work across the aisle to ensure that the NFIP remains able to provide affordable flood insurance so that our nation is resilient in the event of a disaster. So I thank you, Mr. Chairman, and I yield back the balance of my time. And I hope that we can work together in a bipartisan effort in the way that we did to pass the bill that corrected the unintended consequences of Biggard-Waters. I enjoyed doing that. I yield back.
Thank you, Ms. Waters. With that, we'll open with our testimony for the day. We have Mr. Steven Ellis, Vice President, Taxpayers for Common Sense. We have Mr. Christopher Hydrick, Principal of Hydrick and Company Insurance and Risk Management Services, on behalf of the Independent Insurance Agents and Brokers of America. Ms. Patty Templeton-Jones, Executive Vice President and Chief Program Advocate for Wright National Flood Insurance Company, on behalf of Property Casualty Insurers Association of America. And Mr. Tom Woods, 2015 Chairman of the Board, National Association of Home Builders. We had a roundtable last week, which was great from the standpoint that we were looking at the mapping problem, believing that we need to start there. Today's hearing, we hope to build on that with a more broad look at flood insurance as a whole, and then in fact, tomorrow we will look at a private sector solution with a bill that's out there to also take that into consideration. So we're starting off the year with a lot of research and looking into the different aspects of flood insurance, and we look forward to your testimony today. Just to give you a brief tutorial on the lighting system, you get 5 minutes to speak, give us your testimony. At the 1 minute mark, a yellow light will come on. And when you hit red, that means my gavel is close behind. With that, Mr. Ellis, welcome to the committee, and we'll look forward to your testimony. You have 5 minutes.
Thank you. Good morning, Chairman Luke Meyer, Ranking Member Cleaver, Chairman Henserling, Ranking Member Waters, members of the subcommittee. I am Steve Ellis, Vice President of Taxpayers for Common Sense, a national nonpartisan budget watchdog. Thank you for inviting us to testify on opportunities and challenges facing the National Flood Insurance Program. Taxpayers for Common Sense is allied with Smarter Safer, a coalition in favor of promoting public safety through fiscally sound, environmentally responsible approaches to natural catastrophe policy. The groups involved represent a broad set of interests, from free market and taxpayer groups to consumer and housing advocates to environmental and insurance industry groups. All the groups agree that NFIP should be made more responsible and greater reforms are needed. I have a more extensive discussion of the opportunities and challenges facing NFIP in my written testimony, but in my short time now, I'd like to address 4 of the points the committee raised in the letter inviting me to testify. The committee asked, is the NFIP the ideal model for effective protection of residential and commercial property owners? No, and not just because it's $23 billion in debt to taxpayers. As was mentioned, NFIP was created nearly 50 years ago because of a market failure. Today, the insurance industry is hungry for this risk and can provide it. To be clear, I'm not suggesting eliminating NFIP tomorrow or anything close to that. The community rating system encourages mitigation, and there are properties that would see significantly higher premiums in the private marketplace. But a primarily private sector program is where flood insurance is heading and should head, and FEMA has indicated as such about that it's heading this way. This is already happening, and in the coming decades, NFIP will likely become a residual market for policyholders that cannot obtain private flood insurance. This will be a limited set of policies and is not unlike residual homeowners insurance programs at the state level. But Congress should be intentional about this development and ensure mitigation benefits achieved by NFIP are retained and funds for mapping maintained. The committee asked about FEMA's efforts to accurately predict flood risk, price flood risks, and create an effective administrative mechanism to serve policyholders. I know FEMA is working hard to update the maps and has the new Technical Mapping Advisory Council to help guide them in their work. I also know that mapping efforts have not received full funding the last several years, which inhibits their progress. That said, more needs to be done for the public to have a greater understanding of their flood risk. FEMA is tasked with mapping the special flood hazard area for the mandatory purchase requirement. That is a federal mandate that isn't likely to change. However, these maps are static, lines on a map designating various flood risk areas and charging various risks based on those, charging various rates based on those risks. If a homeowner has an elevation certificate that proves they are elevated out of the floodplain, they can have those rates adjusted. But the creation of the rates is a sort of black box that is not entirely clear that even full risk rates are actuarially sound. In some cases, there are significant cross subsidies where lower risk properties pay more to maintain subsidies for higher risk properties. The committee also asked how NFIP in the private sector could better serve high-impacted communities and modernize mapping systems while incorporating local community mitigation efforts. There's no way around it. The maps have to be accurate and smarter. There's a whole industry that has very accurate data. FEMA should explore data sharing and further contracting with them. There are also many different federal agencies that engage in mapping. This should be better coordinated and shared among agencies to avoid duplication. This is also where, and I know this is outside the committee's jurisdiction, the nation's mitigation and pre-disaster programs have to dovetail with NFIP and post-disaster response. Finally, the committee asked about the issue of affordability for families without the resources to pay actuarial flood rates. The affordability issue has to be addressed, but it must be done in a means-tested, targeted, and time-limited manner. Current subsidies are effectively hidden from the homeowner, which eliminates any price signal of risk or incentive to mitigate to reduce the risk and thereby the premium. Masking subsidies with lower rates prevents policyholders from understanding the true level of their risk. As was noted in the privatization report mandated by Biggert Waters, subsidized rates, quote, can promote and have promoted poor decisions on the part of property owners and political representatives. They also create a moral hazard, especially when the subsidies are not well targeted. The report continues that the presence of subsidies, quote, removes the incentive to undertake mitigation efforts, thereby encouraging ever-increasing societal costs. A far better approach is to encourage and fund mitigation measures that could serve to reduce rates by reducing risk. In conclusion, private insurers are ready to write flood insurance, and as NFIP rates rise in the program to be more in line with risk, this will become even more so. With more insurers writing flood insurance, there should be a growth in overall coverage in the United States. While the federal program develops into a residual market, this will take a decade or maybe 2 decades or more, but Congress should work with the executive branch to manage the transition and use targeted mitigation tactics that make these remaining policies more commercially insurable. There is no need for the federal government to further extend into the catastrophe insurance market or through reinsurance or other means. Thank you for the opportunity to testify. I'm happy to answer any questions you might have.
Thank you, Mr. Ellis. Mr. Hydrick, you're next, recognized for 5 minutes.
Thank you. Good morning, Chairman Lukenmeyer, Ranking Member Cleaver, Chairman Hensarling, Ranking Member Waters, members of the subcommittee. My name is Chris Hydrick, and I'm pleased to be here today on behalf of the Independent Insurance Agents and Brokers of America, or the Big I, to present the association's perspective on flood insurance and the National Flood Insurance Program. We commend the subcommittee for looking at this very important issue. I'm the principal of an independent insurance agency located in Sanibel, Florida. I regularly counsel clients of all sizes regarding flood insurance. I also hold the designation of Associate in National Flood Insurance. I currently serve as the chairman of the Big I Flood Insurance Task Force and represent the Big I on the Flood Insurance Producers National Committee. The Big I is the nation's largest and oldest trade association of independent insurance agents and brokers, and we represent a nationwide network of approximately 250,000 agents, brokers, and employees. Working with Write Your Own companies, many of these agents serve as the sales force for the NFIP. It's from this vantage point that Big I members understand the capabilities and challenges of the insurance market when it comes to insuring against flood risks. The Big I believes that the NFIP provides a vital service to the people and places that have been hit by natural disaster. Recent severe flooding in Missouri and across the central United States has provided an unsettling reminder of the terrible damage that flooding can cause, and the NFIP is virtually the only way for many people to protect against the loss of their home and business due to flood damage. Despite our support of the NFIP, the Big I also recognizes that the program is far from perfect. The program has recently faced scrutiny for its handling of Superstorm Sandy claims and has a debt of approximately $23 billion. But it is important to note that for more than 2 decades, up until the 2005 hurricane season, no taxpayer money had been used to support the NFIP. The NFIP was able to support itself using funds from the insurance premiums it collected. In order for the NFIP to move forward towards financial solvency, rate adequacy should be examined. However, it must be done with careful consideration to avoid market disruption and other unintended consequences. For the NFIP to regain any sort of solid financial footing, the number of policies needs to increase, not decrease. As Congress considers possible reforms to the program, careful analysis of their potential impact on policy take-up rates and retention should be paramount. Now I would like to talk about the role of the insurance agent in the delivery of flood insurance, which is considerably more complex than most traditional property and casualty lines. Independent agents are an essential part of the consumer experience when purchasing a flood policy. Placing a new policy on a property located in a special flood hazard area where the government requires flood insurance for any home with a federally backed mortgage is an intensive process that can take multiple days, if not weeks, to complete. Furthermore, when consumers are, quote, not in a flood zone, they often believe they don't need flood insurance, when, in fact, this is not the case. Properties outside of the special flood hazard area comprise over 20% of all NFIP flood insurance claims and receive 1/3 of federal disaster assistance for flooding. It is my job to explain the flood insurance options available to consumers and to make sure they understand the consequences of their purchase decision. As you know, the NFIP is a congressionally authorized program that requires periodic extensions. The NFIP is currently scheduled to expire on September 30th of 2017, and the Big I strongly urges Congress to pass a long-term extension as soon as possible. Instability and uncertainty created by short-term and sometimes retroactive or last-minute extensions can lead to concrete damages in the real estate and development market, as well as the country's economy overall. Briefly, regarding the private market, which I know the subcommittee is exploring in a separate hearing tomorrow, the Big I supports H.R. 2901, the Flood Insurance Market Parity and Modernization Act, as introduced, and would like to thank Representatives Ross and Murphy for taking the lead on this bipartisan legislation. This bill ensures that policyholders can move seamlessly between private market and the NFIP. The Big I believes that the private flood insurance market can play a valuable but limited role as a complement to the NFIP in protecting homes and businesses, but lacks the capability to underwrite flood insurance on a pervasive basis to meet customer needs. In conclusion, the Big I strongly supports the NFIP and the continued role of our members as the distribution force for the program. The NFIP is essential for millions of Americans, and ensuring the long-term stability of the program is of vital importance. I thank the subcommittee for holding this hearing and look forward to any questions you may have.
Thank you, Mr. Hydrick. Well done. Wound up within the time limit there. Good job.
Thank you.
Ms. Templeton-Jones, you're recognized for 5 minutes.
Good morning, Chairman Lichtmeyer, Ranking Member Cleaver, and members of the subcommittee. My name is Patty Templeton-Jones. I'm the Executive Vice President and Chief Program Advocate of Wright National Flood Insurance Company, based in Florida and domiciled in Texas. Thank you for the opportunity to testify. Wright National Flood Insurance Company is a write-your-own flood insurance partner with the NFIP through the Write-Your-Own program. WinFIC is the largest writer of flood insurance in the nation. Wright National Flood Insurance Services, our processing center, is also active in the private flood insurance market, growing outside of the NFIP. Wright National Flood is a member of the Property Casualty Insurers Association of America, which is composed of nearly 1,000 member companies, including 2/3 of the write-your-own insurers that partner with the NFIP to administer the flood insurance program. My testimony today is provided on behalf of PCI and its nearly 1,000 member companies. Today, I would like to first draw your attention to the dramatic increase in private capital available to underwrite flood coverage outside the NFIP. Second, to underscore the importance of consensus for long-term reforms needed to provide stability in the NFIP throughout the lengthy transition period necessary for significant market for flood coverage to develop outside the NFIP. Thirdly, to highlight several key issues policymakers need to consider before any period of transition begins. And lastly, to suggest several broad categories on which such long-term consensus reforms should focus. Without question, the biggest change in flood insurance landscape since Congress last authorized the NFIP is that now, for the first time in a generation, substantial sources of private capital are available and actively interested in writing primary flood insurance coverage. Today, an increasing number of private insurers have entered or are planning to enter the private flood market. In response, state insurance regulators like those from Florida and Pennsylvania are engaging insurers with the intention of fully incorporating flood insurance into the U.S. state system of insurance regulation. The 48-year-old NFIP has experienced significant turmoil over its history. Program uncertainty and confusion peaked between 2008 and 12 as NFIP suffered through a period of more than a dozen short-term program lapses and extensions. Unfortunately, a decade of program uncertainty, lapses, and midstream operational changes have not only caused numerous insurers to leave the write-your-own program, but have repeatedly disrupted the housing market and caused ripple effects throughout the larger economy. Developing consensus on long-term reforms, then restructuring and reauthorizing the NFIP well before the September 2017 expiration is the single most important thing Congress can do to foster certainty in the flood insurance marketplace and encourage the continued development of market-oriented solutions in flood risk management. The availability and interest of significant sources of private capital to provide primary flood insurance coverage outside the NFIP represents a paradigm shift. It presents the opportunity for a gradual transition towards a flood insurance marketplace in which an increasing share of risk is borne by the private capital. However, the growth of a private primary flood insurance market does not mean that the elimination of the need for the NFIP, particularly as private market will not be willing to assume all flood risk or be acceptable to all buyers. In advance of any significant transition in flood insurance market, topics policyholders need to consider are, first, should the NFIP become a national residual market or market of last resort for the substantial number of properties the private market will be unable or unwilling to insure? Second, how is NFIP's mission to encourage the purchase of flood insurance by providing affordable coverage impacted by the growth of the private insurance market? And lastly, how will the NFIP's mapping and flood mitigation functions be funded if policyholders leave the NFIP and purchase private flood insurance? Detailed in my written testimony are a number of immediate operational reforms that FEMA could take up on its own that the subcommittee may wish to consider in an oversight role. In the immediate, Congress could and should bolster the development of a robust private flood insurance market by passing the bipartisan, bicameral Ross-Murphy-Heller-Tester Flood Insurance Market Parity and Modernization Act of 2015, H.R. 2901. This straightforward legislation addresses post-BW12 regulatory confusion and provides homeowners greater coverage options and pricing. In conclusion, PCI and Wright National support the committee's review of the NFIP and consideration of how to encourage additional private participation in flood underwriting and accordingly limit taxpayer risk. We would also suggest that even if the subcommittee and Congress ultimately reshape the marketplace, there will be a necessary long-term transition. Given the NFIP's important role in the lives of so many Americans, it is critical to develop a strong bipartisan consensus for stable long-term reform in advance of the program's 2017 expiration. I thank members of the subcommittee for this timely start reimagining flood risk management in advance of the September 2017 reauthorization of the NFIP. I'm happy to address any questions and look forward to working with the subcommittee throughout this process.
Thank you, Ms. Templeton-Jones. With that, we go to Mr. Woods. Mr. Woods, we want to thank you again for your participation last week in our flood mapping roundtable. I realize this is your second visit to TC in 2 weeks, so we appreciate your willingness to work with us, to enlighten us, and to represent your association, which you do very well. So, again, a fellow Missourian, welcome to our committee, Mr. Woods, and you're recognized for 5 minutes.
Thank you. Chairman Luke Meyer, Ranking Member Cleaver, and members of the subcommittee, thank you for the opportunity to testify today. My name is Tom Woods, and I am a builder from Blue Springs, Missouri, and the NHB chairman of the board. NHB has a long history of supporting NFIP, and we are committed to ensuring that it remains a viable and affordable program to its policyholders while being mindful of the costs to the American taxpayer. NHB commends the subcommittee on addressing this critical issue early in the year, and we look forward to working with you and your colleagues as you contemplate changes to the NFIP to ensure that federally backed flood insurance remains available, affordable, and financially stable. The unprecedented losses suffered in 2005 and in 2012, including the devastation brought on by Hurricanes Katrina and Sandy, have severely taxed and threatened the solvency of the NFIP. While these events have been tragic and sobering, resulting reforms must not be overreaction to exceptional circumstances. Instead, reform should take the form of thoughtful, deliberate, and reasoned solutions. A key step in this process is to take stock of where we are today, what has worked, and what has not. While NHB supported the passage of BW 12 to ensure the continuation of the NFIP, the legislation created unintended consequences that resulted in dramatic flood insurance premium hikes that hurt the sale, construction, and remodeling of homes. The combination of inaccurate mapping into higher risk flood zones and the immediate shift to full actuarial rates for many homeowners resulted in increases that priced prospective buyers out of their developments and forced the cancellation of sales, harming communities. HIFA fixed many of the problems associated with BWPL. It provided that those who were charged higher rates should be refunded for excess premiums, specified that properties should and would continue to pay their grandfather rates, and repealed the requirement that flood insurance premium increase immediately to full actuarial rates upon the sale of a home. The return to grandfathered rate provided a more affordable rate structure for policyholders. NHB has estimated that in 2014, because of HIFAs, there were $755 million more in new construction and $361 million a year in additional remodeling. Any reform efforts need to address the accuracy of the flood insurance rate maps. For flood maps to be fair and accurate, they have to take into account all flood control structures. Consequently, many properties are incorrectly mapped into floodplains, which result in homeowners being forced to purchase unneeded flood insurance. It typically takes years for those mistakes to be fixed, often requiring a lengthy and costly appeals process for the community, builder, and the homeowner. There is an opportunity for home builders or landowners to elevate plots of land out of the floodplain through the letter of map change process. For example, I engaged in a Colmore process in a subdivision I built in Independence, Missouri. It took over 8 months and $250,000 for FEMA to approve the map change. In states with short construction seasons, going through the letter of map change process could create devastating costs and delays. I would like to thank the subcommittee for the opportunity to share NHB's views. Home builders have long supported common sense changes to the NFIP, and we urge Congress to continue to support and protect small business owners and homeowners from the exorbitant rate hikes and inaccurate mapping we have seen in the past. Thank you.
Thank you, Mr. Woods. With that, I want to thank each of the individuals testifying today for your testimony, and without objection, your written statement will be made part of the record. With that, I want to recognize myself for 5 minutes and begin the questioning. Mr. Ellis, you make a lot of different statements, a lot of interesting conjectures as to how things could be, should be. You're looking at private insurance to go that direction. How do we get there, and what do we do with mapping? Is it still necessary if you go to a private insurance market?
Sure. Thank you, Mr. Chairman.
You still need the NFIP, I guess, also.
Right. So there is currently built into the rate structure a certain charge that goes to every policyholder under NFIP that is supposed to go for mapping. And then also there is also appropriations that augment that go for mapping. We believe that as you develop the private marketplace, that there should be explicitly a similar fee, a matching fee for mapping that is done on the private sector policies. It would be exactly the same as what somebody is doing, paying an NFIP, as they would be paying the private sector as this sort of SUR fee, if you would. And that way, one is we still going to have this the mapping required by the federal government to do the mandatory purchase requirement, unless you all decide to change that. And so we need to make sure that is retained. And so that would be how we would envision that would be addressed, Mr. Chairman.
Okay, Mr. Hydrick, one of the things that you were talking about was the low take-up rate. What is your solution for that, or do you have a solution, or do you believe that's just an inherent problem with the nature of flood insurance?
Thank you, Mr. Chairman. I believe the inherent problem is the catastrophic nature of flood risk. As I'm talking to clients, if you think of homeowners insurance, auto insurance, I mean, these are the products that they typically buy every day that can experience higher frequency but sometimes lower severity losses. Flood insurance doesn't work like that. Flood insurance is catastrophic in nature and often hits the people who least expect it. And one of the largest challenges we have in communicating flood risk right now is the binary nature of the existing maps. When you look at frequency, there are only 3 categories the National Flood Insurance Program specifies. Less than a 0.2% chance of flooding in a given year, 0.2 to 0.99%, or 1% or greater. So imagine you have 2 houses that are on either side of a line, whether that line is inside or outside the SFHA or in between 2 flood zones. And the consumers are led to believe that because they're on the safe side of that line, they don't need to purchase flood insurance. The rest of that statement is actually they don't need to purchase flood insurance to satisfy their lender, but there certainly is still a risk. And the relative risk between those 2 homes that I just gave in that example are much closer than in or out.
Along those lines, you know, if it's more difficult for people to ascertain they need it, if you would go to a more private market, how would you market the insurance? Are you going to market it like you do car insurance and homeowners insurance and life insurance, where you would market it as one of those risks that's out there? Do you see a marketing program that would help do this, to show people the need for this? Or is this something that the government's going to have to do, or the local communities who live in floodplain areas are going to have to do? Or how would you market the product if it's a private sector product?
I don't know that I market it any different than I market any other product. When I'm meeting with a client, I'm assessing their overall personal risk, whether that's wind or flood or auto or life or health, where each individual may have a different set of risks, or those risks may be more severe or less severe from individual to individual. One of the things that I believe the private market may be able to do better than the NFIP today is price in a more granular level. So the example I gave before, where there's 2 homes on either side of a line, and sometimes 10 feet can make several $1,000s of difference in the cost of flood insurance for an individual. That's going to weigh heavily on their cost-benefit analysis. But if the private market is able to rate more granular, it'll be a different outcome.
Mr. Woods, you deal with this every day, with the fact that you build homes and hopefully you can sell them. financiers are supposed to be required to have in their files a document that says this either is or is not subject to flood insurance. How do you see this playing out with the private market? How do we solve this problem of participation?
I think number one, again, and not to beat it to death, but the flood maps have to be accurate. Without that, you're at a loss. You can't make that judgment. The second thing is simply an educational process. Right now, we're working where the only person having to have flood insurance is that person that's within the 1% area. And there are a number of answers to that question. Right now, new construction in those areas and significant remodeling, you are required to move the base elevation of that house above the floodplain by whatever means. And then as you go down through the list, there are others. So I think you do it through education, but I think you have to have the confidence, and the home builder, the city, the homeowner have to have the confidence that those maps are correct.
Okay, very good. My time's expired. With that, I will recognize the ranking member of the entire committee, Ms. Waters, for 5 minutes.
Thank you very much, Mr. Chairman. I'd like to thank all of our panelists who are here today, and I'm especially listening to Mr. Woods from Missouri. I'm from Missouri, and you have 2 members on this committee, 3 members who represent Missouri, and the recent floods, all of the flooding that has taken place in Missouri and in that St. Louis area where rivers converge, I guess, have caused me great concern, as I've been concerned about the other areas of this country. And I've spent a lot of time after Katrina working down there with the residents who were just so harmed by Katrina. I was part of a problem. Biggert Waters was not right, and it increased those premiums for homeowners, but I was part of a temporary solution also to fix that. And now I'm interested in a permanent solution, and I agree with you. If we can't get the mapping right, we won't be able to do the reform that's absolute and needed in this program. And so I guess you have already said it, but would you just reiterate how important it is for us to get the maps right? I don't know what it's going to take. I know it's going to take some more resources to do that. It's going to take expertise that should be both public and private. But would you reiterate for us the importance of mapping?
Certainly. Without a correct map, all that we do other than that is really wasted. None of us can guarantee what the outcome will be. But I want you to understand also about the mapping and why it's so important. The map is only good if the local community follows the map. And I'll give you an example, back to the Independence example. I could move all of my property, in fact, above the 500-year floodplain, simply by constructing some lakes in the area and elevating the rest of the ground. I could contain all of my water on site. However, the one thing I could not address is waters that were coming to me from other areas. So it can't be a piecemeal one spot area. It's gotta have the hydraulics of the entire floodplain within it. The second thing is there are some tremendous cost savings to be, I believe, realized. 2 points. I, in fact, mapped the floodplain. I, in fact, knew where there were some errors in the floodplain that have existed for years, and yet we have not been able to get them addressed. All right? So I believe that we ought to rely on that data, if accurate. It wouldn't then require a second set of mapping. It would require a review. And the second thing is, and this may be a novel approach for here, but we need to stop spending all our money suing each other to prove who's right. And ultimately, I was the winner. But the bottom line is that money could have well been spent to have improved both the mapping and the area if we were working together.
If I may just continue. There are some people who believe it's impossible to get this remapping done, and to that it is going to cost too much money, that even some people question the expertise, but you believe that it can be done, is that right?
I believe it can be done if we all work together. And I think you have to go with where is it important to remap? I mean, it's not all that important to perhaps remap many areas of the country where there isn't that much exposure. Those areas that have the most population, the most economic drive, those are certainly the ones that should come first. But those are also the areas where you're going to have the help of the home builders, the developers, perhaps the cities. I think they're all interested in this.
So you do believe that the private sector could really help us in getting this remapping done?
It could help you, but they're going to have to know that there is an effort from the regulator side to, I'm not asking to accept anything that's not right, but I'm asking to stop being adversarial throughout this whole process.
Well, I do believe that the chairman of this subcommittee, Mr. Lukemeyer, who is from Missouri, is headed in the right direction. And I do believe that he can get all of the forces together so that we can get this right. So I'm very optimistic, and I thank you for your testimony.
We thank the ranking member. Time's expired. With that, we recognize the gentleman from New Mexico, Mr. Pierce, for 5 minutes.
Thank you, Mr. Chairman. Mr. Woods, could you, give us a little bit more explanation? You said if the regulators would stop being adversarial, I think was your last statement. Could you give us a little bit more insight into that adversarial relationship?
Well, just recently, a flood map was adopted in the Little Blue River Basin in Independence, Kansas City. It runs through both cities. And in fact, we knew there were errors in that map. The cities knew there were errors in that map. The two cities' maps did not match. And the bottom line was, I was told when I asked the question of some people at FEMA, basically told, well, why didn't you step up and provide it? Number one, in the economic conditions that we're in, I wasn't able to do that. It wasn't worth my time. But they had that information. In fact, the major change in that flood map, two major changes in that flood map, was a realignment, regrading of the Little Blue River, which is the river that would be flooding those grounds for the most part. And that was done by the Corps of Engineers 10, 12 years ago. The changes the Corps made were not reflected in the map. Readily available, I would believe. Secondly, there was a federal road project in that area. And during that road project, they took two of the bigger bottlenecks out of the floodplain with some bridges and that kind of thing that they did. Those significantly changed the way that floodplain operated. And that information was readily available from, the highway department. But they were still not included because they're simply not playing, they're not playing team ball. And so those are all very important. And the last thing was just the way, when we submitted for our CLOM RF, we went out, we did a little different. Before we submitted and before we even did the plan, we invited all of the parties to the site, which is about 500 acres, and physically wanted to walk the site with them and show that we could be good stewards, we could improve wetlands, we could stop the flooding, we could enhance the property. And the result wasn't what I expected. We quite frankly became the guinea pig instead of.
We've undertaken 2 rewrites of floodplains ourselves as an office, and it's much more difficult than it should. You have the facts, they have the facts, but they refuse to rewrite it. So I just wanted to get your insights on that. If a builder knows that an area is not being described in the floodplain, is he allowed to go in and make the changes with his knowledge that it is actually in a floodplain, or does the agency stop him from doing that?
The agency stops him from doing
See, I mean,
that.
this is the craziness that is called the U.S. government today. Mr. Hydrick, basically, it was my understanding that the insurance program, the flood insurance program, was solvent up until maybe 10 years ago, just with whatever flood it was before Katrina. So it was about $1 billion in, $1 billion out. Then we had a several billion-dollar problem, and then Katrina followed up with about a $13 billion problem. So now we're underwater in the program. Is the program basically back to solvent, about the same amount in, the same amount out, except for these catastrophic events, or is it not even close to solvent these days?
It's my understanding, excuse me, thank you for recognizing me. It's my understanding that the $23 billion in debt really represents those two extraordinarily rare catastrophic events, which are Katrina and Sandy. Outside of those events, the program will be operating just as it was originally designed, which is without surplus, instead of surplus, a line of credit to the U.S. Treasury where it would borrow during years of need and pay back during other years.
Yeah. Mr. Ellis, do you know if anyone has done extensive studies on the fraud? I know that I was in New Orleans maybe a year or 2 years after the bailout and the money that was sent down there, and billions of dollars sent, and just story after story in the short time I was there about people collecting the money and never fixing the houses. Has anyone done an extensive study on that to determine the amount of fraud in these programs?
The lead inspector general after Katrina was Department of Homeland Security Inspector General, and they kind of led all the other agencies, and they did a lot of investigation into that area. And then there's been some documentation on that. GAO also did a report on mispayments a couple years ago as well.
Is it extensive?
It's it's present. I think anytime you have a federal program, you're going to have some waste, fraud, and abuse, unfortunately, which keeps people like me in business. And so I think that that's still going to be an issue. And one other thing, Mr. Pierce, I just want to point out is that we knew these catastrophic events were going to happen. So even if it was on the margins, the program was actually solvent. In large scale, we knew that there would be some event. We didn't know it would be Katrina and Rita and Wilma in 2005, and we didn't know it would be Sandy in 2012, but we knew that something was going to happen to make this program insolvent.
Thank you. Yield back, Mr. Chairman.
Gentleman's time has expired. With that, we go to the gentleman from Missouri, Mr. Cleaver, the ranking member of the subcommittee.
Thank you, Mr. Chairman. And let me preface my questions to the panel by thanking you again for this meeting. There's a lot of criticism thrown on Congress for waiting till the last minute and so forth. And the fact that we're starting on this right after the new year and giving us almost a year to do this, I think is commendable. So thank you very much. I want to find out if any of you on the panel believe that Congress should that Congress should completely eliminate the NFIP. Is there anyone? I'm glad because we've tried that a couple of times, and it didn't work, which I understand. Most of the private carriers have suggested previously in hearings before us, not during this session of Congress, but previously, that the private insurers could not diversify their losses, and so it made it practically impossible. And if you pay $130 premiums, if you put all the premiums together, they were not sufficient to cover the cost of the damage of a flood. So is there anything that you think we could do to further encourage private insurers to participate in this program? Anyone? Mr. Ellis.
Mr. Ranking Member Cleaver, absolutely. I mean, tomorrow you're going to have a hearing on Mr. Ross's bill, along with Mr. Murphy, that would actually fix just the definition of what would represent insurance that was met the mandatory purchase requirement. There are insurers in other states, even after Bigger Waters was enacted, before the subsequent legislation that we're starting to, in West Virginia and in Florida, that wanted to write insurance. So there's definitely an appetite and an effort there. Some of it is just making it easier for that program to develop. And then actually also, I think that which will also bring the private sector in is some of the consumer demand, because flood insurance is, as was indicated by Mr. Hydrick, is a pretty limited product. I mean, you can't insure your basements. You have a limited $250,000 plus $100,000 for contents. There's other things that they can do and products that they can make that are going to attract new ratepayer or new policyholders on a product basis.
So how many of you would thought or believe that the revolving loan fund that was actually at one time started was the right direction to go? There was a revolving loan fund up until, I think, maybe in the 80s, sometime in the 80s. And eventually, the private sector was in with FEMA, and they ended up in some kind of conflict, and both sides mutually agreed to discontinue the revolving loan fund.
My understanding, Ranking Member Cleaver, in the 80s was that also that was when they changed to actually having borrowing from the Treasury. Before that, there were appropriations that would backfill and dealt with that, and they forgave about $1 billion of debt and then went to borrowing from the Treasury. That's my major recollection at that time.
Yeah. Well, what would you suggest, any of you, suggest that this committee look at in terms of trying to put together the best piece of legislation we can when the renewal time approach is closer to us?
I'd like to also support Mr. Ellis's comment about HR 2901. I think 2901 is the first and a very important piece of legislation that will enable the private sector to start moving into the marketplace. We're starting to see, because of private capital, private markets are moving in, slowly but surely. We're seeing them move in with some better coverage, many times less expensive premiums. But in order to clarify the Biggert-Waters definition of what private flood insurance is acceptable, I think it's essential that 2901 be passed, as well as we need to eliminate the non-compete clause in the program.
Thank you. Mr. Woods mentioned the 500-year floods. I served as mayor for 8 years of Kansas City. We had 2 500-year floods in 8 years. And also, let me just conclude, Mr. Chairman, by just saying I think the mapping is a critical issue that has to be resolved. Thank you.
Thanks, gentlemen. Time's expired. With that, we go to the gentleman from Florida, Mr. Ross, for 5 minutes.
Thank you, Chairman, and I thank the panel for being here. In 1973, it seemed like a good idea that we would carve out from an all-perils policy flood insurance. It just seemed like the thing to do at the time on behalf of consumers. As we fast forward to today, it's somewhat akin to have carved out cardiology coverage under a health insurance policy and led to terrible results and not to the benefit of the consumer. And so trying to put these back together, I think, is not necessarily a function of the federal government, but more a function of those who are willing to put at risk their capital to make sure that they can not only manage that risk, but to do so at the benefit of the consumer. Mr. Ellis, you talk in your testimony about an all-perils policy, that including flood into an all-perils policy may, quite frankly, not only engage the consumer into wanting to buy flood insurance at a cheaper price because they'll have limited risk, but yet the price of it would be so much cheaper that we, in fact, may cover more people through the privatization of flood insurance and putting it into an all-perils policy. Would you expound on that?
Absolutely. I mean, right now, there's about, it's changes and it's been going down. There's about 5.3 million national flood insurance policies in the country. Put that in perspective, leaving aside multi-unit housing, there's about 100 million housing units in this country. So we already have an adverse selection and not very many people buying flood insurance. And even though FEMA says that a lot of their payouts are to people who are outside the mandatory purchase requirement area. And so if this becomes a product that then insurance companies can sell to their clients, then all of a sudden it becomes less expensive. More people will be covered. We know these floods happen in these areas that are not in the 100-year floodplain, has been indicated, and so we could see an expansion in coverage in this country, which is certainly what we would like to see happen.
And any more sharing or pooling of the risk across?
Absolutely. We also would like to see a lot of that risk being
At a more
removed from the
affordable
taxpayer
price
and onto the private
consumer.
sector where it belongs. Absolutely.
Correct. In August of 2015, FEMA stated in their reinsurance study that reinsuring a portion of the NFIP's insurance risk would be a logical step towards privatization and could provide an additional lever in the financial management of the NFIP. To your knowledge, has NFIP or FEMA attempted to broaden their or cede their exposure to the reinsurance markets?
I don't know if they've actually gone further from that study, and that was, I mean, they had the reinsurance study was done by Guy Carpenter, and then that was their opinion on top of it. And so, you know, we would like to see the committee prod FEMA to go that direction and to explore that more.
And if I might, Ms. Templeton-Jones.
I'd just like to advise, I've been made aware that FEMA has reached out to some reinsurers.
Good.
Reinsurers have met with FEMA. So I do think the process is beginning.
And is your understanding that there is capacity in the reinsurance markets to take a significant portion of this risk?
Absolutely there is.
Let's talk about, Ms. Templeton-Jones, about the process that was alluded to earlier. Let's assume, because I have a good friend of mine who's a registered land surveyor, site work contractor back home, who lives in a house on a hill that at the base of the hill is in a floodplain. There's no structures, but he's 20 foot above. He has all the documentation because he can do it himself, but it's not worth his time and effort to challenge FEMA about his flood mapping, so he's buying flood insurance. Do you believe that if you put capital into the market from private companies, that a consumer would have a better opportunity, a better due process, and a better result if they were able to prove that their home was no longer in a flood zone?
Absolutely, and I'd like to take that just one step farther on that. I think as the private market evolves, and again, I want to clarify that this is going to be a long-term process.
It is.
It's not going to be something overnight. But as the private market evolves, they will utilize more and more tools. Modeling will become more efficient. We'll see better risk analysis tools to enable that company to take that insurance and probably price it better with better coverage.
And risk and manage that risk better. In other words, to be able to help the consumer mitigate their exposure. Mr. Woods, you talked about how you would build a home, the site you would build above the flood zone, and you could contour the land. For every $1 that we spend in mitigation, pre-events funding, we save $4 in disaster relief. What this big parcel is, not getting rid of NFIP. That's not our goal. Our goal, as Mr. Ellis has pointed out, is to make it a residual market. We did this in Florida to a great degree as a bad example for several years in windstorm, but what we've done is we've been able to create a residual market and create a competitive market so that consumers can get the best product at the best price. That entails the private market. Mapping is not an exclusive function of FEMA. If we put private capital into the market, I submit to you, you would see so much technology come into the game to be able to map not only better, but more granularly, because the capital that's put at risk wants to be managed better. Would anybody disagree with that? Thank you. My time's up. I yield back.
Thank the gentleman. Time has expired. With that, we go to another gentleman from Missouri, Mr. Clay, for 5 minutes.
Thank you, Mr. Chairman, and thank you and the ranking member for conducting this hearing. Mr. Ellis, the question of how to balance the goals of affordability and risk-based rates has been a key question for Congress in seeking to improve the National Flood Insurance Program over the years. Do you believe that these goals are fundamentally opposed, or do you believe that there is a way to appropriately balance these goals?
I believe there is a way, and we have to find a way, Mr. Clay, Congressman Clay. What we've said is that right now, when you have the subsidies that are built into the program, they're relatively hidden from the consumer. There isn't an explicit knowledge of what the subsidy is, and then also they're not means tested. I mean, it's basically if you own the house that was pre-firmed, was before the flood insurance rate map, you get the subsidy. And so we think that as rates increase, and we think they do need to increase, if there are cases, we need to do a means tested, and we need to have very targeted assistance that's outside the rate structure. And we're open to talking about ways to do that. The Wharton Risk Center has talked about vouchers. There's been other ways of looking at how to address that for that core. And then also the other thing is that, you know, reducing the rate or making people pay less doesn't reduce their risk at all. It doesn't encourage them to reduce their risk at all. And so to some extent, one of the things that we've talked about is also looking at even pre-funding some of that subsidy so that people can actually use that to mitigate and reduce their rate by reducing their risk. And so that way, we're not putting people in harm's way, encouraging and subsidizing people to be in harm's way, but we're actually helping them out of the floodplain.
Thank you for that response. Mr. Woods, an example of Missourians rebuilding. Just recently, over the holidays, we experienced flooding in and around the St. Louis region. One community allowed for the homes to be elevated after the last flood. I guess they put some of the houses on stilts, I'll say. Do you think that's smart as far as allowing them to remain there and raise the elevation? I mean, this time they still had to evacuate the community because the water rose too high. What do you think about them elevating and raising the level of the house?
Please, your microphone's off, sir.
I think that there are all kinds of economic issues that start to play into this, and elevating may be the solution. But there are other solutions to look at. Would it have been less expensive, less catastrophic to have moved those houses someplace else in the flood, out of the floodplain? And again, where would that be? And what you really get into is many of those people are probably close to their jobs. Yeah. That may be the only house they can afford. All kinds of things. So it's not an easy question. And I think it's greatly driven by just the demographics of the area. But at the same time, I think you have to have a comprehensive solution that includes the city and the county, and the state, so that we're making good decisions based on good science.
Another question. Can you explain why the removal of grandfathered and subsidized rates on existing homes is a concern to your organization, which represents the interests of builders of newly constructed homes?
Yeah. Well, if you do that, basically for home builders, nearly 50% of all prospective home buyers are what are called move-up buyers. Mm-hmm. Your person with a house on stilts, or before stilts, okay? These individuals must be able to sell their current home. And if you took away that subsidy or the grandfathering the rates, you're going to devastate the price of that home. And they are no longer going to be move-up buyers. They will simply be trapped in that residence for the rest of them. Again, we rely on the ability of homeowners to move up in order to buy newly constructed homes. Many home builders and many homeowners have lost the ability to buy or the ability to sell simply because of that rate structure.
Well, thank you for your response, Mr. Chairman. I yield back.
Gentleman's time says he yields back. And with that, we go to the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. We'll start with Mr. Ellis, and the question I have is, can you describe how the National Flood Insurance Program discourages private insurance, if at all?
Well, right now, I mean, we talked a little bit about Mr. Ross's bill. I mean, one of the issues has been what exactly constitutes a private policy that would meet the mandatory purchase requirement, and his bill would clear that up and allowing the state insurance regulators to designate that. But that doesn't get to, that's just dealing with the mandatory purchase requirement. Obviously, there are people who do purchase flood insurance that are outside the floodplain, and part of it is that if you have, if the federal government is undercutting the rate, is actually selling at a subsidized rate, both because either the rate is explicitly subsidized or because they can borrow from the Treasury, then you're really undercutting and crowding out the private marketplace. We believe that as rates increase, which they have been, that will become more competitive and actually allow the private sector to step in.
Thank you. How do we, for those who are at risk, who are presently not mandated to have flood insurance, how do we do a better job encouraging those individuals to go ahead and get the coverage? Is it the all perils policy? Is it more capacity in reinsurance, inviting more reinsurance in there? I mean, what is the best way to do that?
Congressman Barr, I think that it is, the all perils and being able, and as the private sector gets more engaged in the flood insurance market, and some of that will be because of clearing up some of the issues in the 100-year floodplain or the special flood hazard area, then there'll be more companies writing policies, there'll be more experience with writing policies, and that should actually attract consumers and actually more policy holders. I mean, that's certainly what we believe and think that will happen.
The reason why I ask is because in flood-prone areas without the mandate to purchase flood insurance, I think the statistic is that only 1% of those structures are insured. So, getting that developing that marketplace is very critical. To Mr. Woods, though, my question to you all would be, is moving toward actuarially sound rates and risk-based pricing, is that a real impediment to real estate transactions? And I'd like to hear your thoughts on that.
I don't know that it is.
Okay.
I mean, I don't have any information, and we don't have any policy. We're going to be discussing this very thing this next week in depth at our meeting, but I tend to lean on the side of open competition usually gets you the best answer.
We've seen in my area, in central and eastern Kentucky, real problems with the accuracy of the maps, and Mr. Woods, I couldn't agree with you more. We've got to get to more accuracy in maps as part of that process of inviting more coverage. Can any of you all elaborate a little bit more on some of the issues that your members of your associations have had with these maps, and what are some of the ways that we can improve the mapping?
If I may.
Sure. Yeah, go ahead.
Thank you, Mr. Barr. As I stated earlier, having a more granular view of flood risk is, I think, of paramount importance to consumers who live outside of the special flood hazard area. 20% of all flood insurance claims occur outside of the special flood hazard area. In Columbia, South Carolina, from what I understand, about 792 people had flood insurance policies. These are examples where if you had a way to measure risk, maybe on a scale of 0 to 100, for instance, and I know that the NFIP is currently working on some way to articulate risk in this way to help customers understand that they're not immune from flooding simply because they live on one side of a line or another, we'd have much more recognition. It would improve the take-up rate.
Mr. Ellis?
Yes, Congressman Barr. Also, I mean, there is a lot of mapping that's being done and modeling that's being done by the private sector, companies like CoreLogic that have some of this data, and I think it's important. I believe, as Mr. Hydrick mentioned before, I mean, the maps that FEMA does are really, a snapshot, and they're looking backwards. The risk modeling is looking forward, recognizing there are changes in development and other patterns, and that can help inform consumers more that they have this risk. It's not this binary situation where you either have to buy it or you don't have to buy it, and if you don't have to buy it, then you think you're not at risk, but in reality, you're at some risk, and it could be quite considerable.
Yes, ma'am.
I'd just like to elaborate one piece. I absolutely support flood modeling. I think we're seeing it. But I do want to make sure the committee realizes it's in its infancy. It's going to get better. Mapping needs to be the starting point, and then we need to build upon that with the modeling and so forth.
Thank you. I think my time has expired. Thank you for your testimony. Yield back.
Gentleman's time has expired. With that, we go to the gentleman from Texas, Mr. Green. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Ranking Member. Thank the witnesses for appearing as well. Let's, for just a moment, look at the markets in terms of how they impact affordability. And more specifically, the residual market juxtaposed to the voluntary market. For our purposes, I think it's fair to say that the residual market is the market of last resort. The voluntary market is a competitive market. And the way we structure the residual market is going to have a lot to do with affordability. So I'd like Mr. Ellis to visit with you because I've read your testimony in its entirety, and the last paragraph of it where you give your conclusion, I think is quite revealing. You indicate that the federal government will develop the residual market. How will that market be developed such that we will still have competition in the voluntary market and not have the taxpayers assume all of the high-risk persons that the voluntary competitive market does not find beneficial in the sense of profits and loss market demands? And I mention this to you because, as you know, with the health insurance, we find ourselves with insurance companies assuming a lot of clients, if you will, who are not over age 62 to 65. When you get above that, the insurance companies are not enthralled with the notion of having you as a client, customer. And given that I'm above that age, I kind of look into these things, as you can well understand. And I see you smiling, so you understand what I'm talking about. So what I'm interested in is finding out, how do we have a residual market that will have a positive impact on affordability, given that the voluntary market is where everybody wants to be, and getting insurance companies to go residual can be exceedingly difficult?
Thank you very much, Congressman Green, for the question. Part of what we were observing, and was actually observed in the reports that came out after Bigger Waters, the FEMA reports that came out, is that the residual market is where it is actually going. Unintentionally or intentionally, that is what is developing as the rates increase in the flood insurance program and as competition is going to come in. And so our point has been that it needs to be, and I think you're spot on, Congressman, is that it needs to be an intentional decision by Congress on how to develop that and how to protect those consumers. Also, as it becomes a more concentrated market, then it's become something where Congress and the executive branch can target mitigation to help those people out. So it's not just about affordability because we're giving them subsidies or we're giving them a cheaper product, but we're actually reducing their risk so that there becomes an appetite in the private sector to write policies for them as well. Because unlike your example in the healthcare, which I'm not an expert in that area at all, but it isn't that there is a 60-year-old house. It's not that houses get to being over 60. I mean, obviously there are houses that are 100-year-old, but I mean that same characteristic isn't analogous. We can actually make that 60-year-old house, at least in a risk standpoint, be a 30-year-old house if we do the right mitigation tactics.
Given that I have about a minute and 18 seconds left, permit me to ask this. Help me to flesh it out. Help me to understand, and others who are listening at home, to understand what you would do specifically to make sure that the residual market is affordable for persons who are going to live along the Gulf Coast. I'm from Texas. I went through Katrina, Rita, and those who are on the East Coast where we had Sandy. How do they have affordability? Give me some examples of how it can be done.
Well, there's one of the things that came out of Wharton was this idea of vouchers to help people purchase their insurance. But I also think, and I know I'm kind of going back to this, I think we should be trying to mitigate their risk and providing them assistance to mitigate their risk to reduce their rate rather than just giving them subsidies. But we already have certain affordability provisions built into flood insurance with the pre-firm structures that have explicitly grandfathered and subsidized rates.
And by mitigation, you mean cost to replace or repair?
Well, no, not to repair or replace. Well, it could be to relocate, but it also could be, to elevate or other mitigation tactics. I mean, I think that what we want to do is reduce the risk. It was brought up earlier that, for every dollar we spend on mitigation, it's $4 less in disaster costs, and we think that would be the way to target it.
Thank you, Mr. Chairman. I yield back.
Gentleman's time has expired. With that, we go to the gentleman from Pennsylvania. Mr. Rothfuss is recognized for 5 minutes.
Thank you, Mr. Chairman.
I'm going to leave it to you.
Mr. Hydrick, in your written testimony, you assert that, quote, private insurance industry lacks the capability to underwrite flood insurance on a pervasive basis to meet customer needs. Could you elaborate on how you and the Big I arrived at that assessment?
Sure. This is a market that's in its infancy. In the U.S., there are not a lot of insurers who have a lot of expertise. There's a dearth of claim data. Claim data is lacking. without having loss experience and the ability to price accurately based on that experience. Those are impediments that will, we believe, Big I believes, will be overcome over time, and modeling will get better over time. But as we sit today, we don't believe that the private market is capable of fully replacing the NFIP.
Are there reforms outside of the Ross-Murphy legislation that the committee should consider to remove barriers preventing the private sector from contributing to the flood insurance market?
I believe that there are a number of reforms that are already existing that will play out over time, will manifest themselves over time. The changes that were made in 2012 and 2014 were aimed to bring rates up to a more something that's more reflective of a market level. There's actually a flip side to that coin as well, though. It also resulted in some number of policies, and according to the NFIP, 80% of the NFIP policies are actuarially correct, had actually a correct rating before those measures were put in place. So now there are additional surcharges and assessments that are outside of the true cost of risk that actually are going to give the private market an ability to come in, and they don't need to charge those for those costs. So it's going to make some risks more attractive to the private market.
Ms. Templeton-Jones, Biggert-Waters attempted to address the issue of those properties with multiple damage claims that have been a serious financial drain for the NFIP. Do you believe that FEMA and the NFIP have the tools necessary to address high-risk, repetitive loss properties?
I think Biggert-Waters 12 was absolutely a beginning of to head in that right direction. I think the challenge still is the biggest drain on the NFIP is the severe repetitive loss properties, and I believe targeted mitigation efforts should be addressed to those properties.
Beyond the targeted mitigation efforts, would there be any other reforms that you might propose?
I think targeted mitigation on those severe repetitive loss properties is the key on that.
Mr. Woods, with the NFIP being $23 billion in debt, GAO has classified the program as high risk, citing NFIP's artificially low rates, which are insufficient to cover obligations and projected losses. I worry, and many of us on both sides of the aisle are deeply concerned that another catastrophic event could push the NFIP's debt level above the $30 billion mark. In your testimony, you write about the importance of ensuring that this taxpayer-backed program is financially stable so that it can continue to meet the needs of its participants. I think we can both agree that the current situation is unacceptable to the taxpayer. What are some ways that we can improve the financial sustainability of the NFIP and reduce taxpayer exposure to significant losses?
Again, I think from what Ms. Templeton-Jones said, I think also from the fact that if you got the private sector involved in the competition that would take place there, and again, we go back to the mapping, but the reality of the mapping is there are many things, and I happen to think if we were all on the same side, the insurance company wanted to sell insurance, the home builder and developer wanted to develop ground, that we would work together to find a solution that gave each of us the best chance of success. That is not happening today in the system. We're spending all of our money on people that are almost guaranteed, well, we're not spending all of our money there, but we're really spending the money on people that are guaranteed to have a flood. I mean, we've insured property, and the ones we're insuring are pretty well guaranteed to have the loss. That's fine, but I think you could do these other things that would help us all in the free enterprise system. They won't do it in one afternoon, and unfortunately, we might get that disaster in one afternoon, but the reality is over a period of time, I believe they could.
There remains a concern with affordability in my district in western Pennsylvania. Mr. Ellis, you touched on affordability. Can you elaborate on some of your ideas on how NFIP can address this affordability issue?
Well, Congressman, as the rates increase, one of the issues we talked about, and I mentioned earlier, was the Wharton study looking at vouchers and sort of something outside the rate structure. I mean, that's our biggest thing is making sure that people know their risk by knowing their actual rate, and then whatever we do as a country to help those people purchase insurance, that it be outside the rate structure. so that they can actually inform them of their risk and then help them mitigate that.
Mr. Hydrick or Ms. Templeton-Jones have any thoughts on, oh, I guess I'm over. I'll yield back. Thank you, Mr. Chairman.
Darn that clock, right? Gentleman's time's expired. With that, we go to the gentlelady from Wisconsin, Ms. Moore, for 5 minutes.
Thank you so much, Mr. Chairman, and let me join the chairman and ranking member in thanking and welcoming this distinguished panel. It's hard to know who to ask questions of because all of you, your testimony has been very compelling. But I want to prioritize, I'm going to ask a question, I want to prioritize getting answers from Mr. Ellis, Mr. Woods, and Mr. Hydrick, and just want to reference the fact that Ms. Templeton-Jones, in your testimony, you talked about the numbers of insurers that are just leaving the program because of the lapses and so on. So with that in mind, my question relates to a provision that I was able to get into the Biggert Waters legislation, just a simple study of community-based insurance. And I was just wondering how some of the challenges, I believe it was Mr. Ellis, you mentioned, you laid it out very clearly, the debt, adverse selection, subsidies, the accuracy or lack thereof of the mapping. How would a community-based flood program fit in with some of the solutions that you all have suggested, you know, giving incentives for cities and states to do mitigation, really bringing more reinsurance and money and private sector dollars into a program, maybe mitigating the adverse selection by having a community-wide effort. Just wondering what your thoughts were on that.
Thank you, Congresswoman Moore. So and that study did result in a National Academy of Sciences report that came out recently. There was also one done by Resources for the Future that was very interesting. I think the challenge is that in 1968 we went with an individual policyholder perspective and having it house by house. You know, you can see in certain ways that maybe even layering it on. You know, you think about the fact that people will have lower homeowners insurance rates if the community puts in fire hydrants and, you know, such a regular pattern. And so there's certainly things that a community insurance could try to overall reduce the individual homeowners rates and that perspective. And then also, you know, that was part of what I think that when they created the community rating system and required communities to actually opt into the flood insurance program, agree to operate under certain restrictions, and then also gave them benefit to their homeowners if they actually did community-wide mitigation measures or whatever. That actually is trying to replicate that, but I would recommend the Resources for the Future analysis on that.
Okay. Mr. Hydrick?
Thank you, Ms. Moore. The Big I doesn't have a formal position on community-based insurance in general. It's an organization that supports choice for consumers to make their own decisions based on their own individual risk, given the great, and there's, of course, there's, as we discussed earlier, there's gradation of risk. There are some people who are at more risk than others when it comes to flood insurance. So we think that those are factors that would have to weigh into a proposal.
Okay, Mr. Woods?
Turn your microphone on, please.
This is a very technical place.
Wait till you read the laws.
I think there are, with the community's involvement, I think there are ways to allow people to have a choice, and I think that choice is always important, but I think it does take the involvement of many of us, the insurers as well as the communities as well as the builders and remodelers and the homeowners.
And you don't think that this would help with the cost, some of the challenges that were mentioned, to have a community-wide plan? I mean, if I don't particularly live in a floodplain, but I find myself paying, you know, 15 cents per $1,000 of value on my property for a community plan, where maybe somebody else pays more because they actually live in the floodplain. Just say New Orleans, if I'm in the Garden District, but I pay a very small premium to sort of mitigate or as a community plan, you can't see a place for that?
I guess I would say yes, there's possibly a place for that, and that kind of falls to that answer I had about being able to control my own piece of property, but I can't do it without the community working with the others. So I think it's the same thing. I would also offer, we're already paying those rates. We're paying them in our taxes to the United States government, and we're paying them in our taxes to the communities right now, because when it happens, we step up. That's what we do in the United States. And when we step up, we're spending that money.
Thank you. I yield back.
Gentleman's lady has expired. With that, we go to the gentleman from California. Mr. Royce is recognized for 5 minutes.
Thank you, Mr. Chairman. I just would build on a conversation that Mr. Clay had, and this was, Mr. Ellis, in your testimony, you meant that you said that masking subsidies with lower rates prevents policyholders from understanding their true level of risk. Is my understanding correct that under the current program, policyholders just see the premium payment that they need to make, right?
That's my understanding, yes.
That's
yes,
what they can see. How difficult would it be to break out the subsidy? How difficult would it be to make transparent the amount that the government or, you know, the other taxpayers are covering on behalf of the homeowner?
One of the challenges will be is for many of the policies that get the grandfather, the subsidized rate, the pre-flood insurance rate map policies, they don't actually know the elevation of the actual policy, and so then there's some of the challenges in dealing with that. But I think that's something to be worth doing, especially considering, as you know, we've recommended that anything going forward, if we're trying to do affordability issues, that the subsidy or whatever the support be means tested and be outside the rate structure. And so I think it would be a valuable effort, Congressman Royce.
Well, it seems to me that you could, if you can capture the information, that the increased transparency there would have a positive impact on future decision-making, because it would probably, you know, decrease moral hazard. It would increase mitigation efforts, perhaps. But letting the policyholder understand that up front would be helpful. And my other point was the Flood Insurance Program Act of 2012 attempted to address the issue of repetitive loss priorities. And this is where multiple claims have been made on the same property. So the GAO found that while these properties amount to 1% of policies, they account for 40% of all of the program claim losses. Do you think the 2012 reform bill gave the NFIP the tools necessary to address high-risk, repetitive loss properties, and what else could be done there?
Sure, Congressman Royce. Certainly in Bigger Waters 2012, they had the provision there about increasing rates for severe repetitive loss properties. That did not get changed in the subsequent legislation, so that is still going on, and so we think that is a positive step. But I think that also looking at some of the programs that FEMA already has to actually, they have the ICC program with like a $30,000 cap, and you could potentially increase that cap on trying to help people elevate or mitigate or relocate. And so I think there are things that we should be targeting our resources, because as you pointed out, Congressman, it is such a drain on the program that those are the most likely, the most beneficial, the best investment to try to mitigate or relocate them out of the floodplain.
Yeah, and I think if people understand better the risks they were taking, or the likelihood, and if all of that data may, well, let's hear some of the other perspectives on that issue, if I could just open it up.
I agree. I think we need to indicate what the actual rate is. We need to be actual rated policies. The challenge is, like Mr. Ellis had said, unless we have the elevation certificate, and not all properties, your pre-firm properties, your older structures, your properties are in the BC-NEX zones, which, again, we need to remember that 25% of all claims come out of your low to moderate risk properties, the BC-NEX areas. We don't have the elevation data. Without that elevation data, we can get an idea, and come April 2016, FEMA is implementing clear, concise information to the policyholder, but again, not having that elevation is an impediment to it.
But it's, you know, it's not that many claims. There are not that many areas that we're discussing in the general scheme of things, how difficult would it be to try to obtain that information?
Mr. Royce, today it's house by house by house.
Yes.
And it requires a surveyor to go out, and the cost of that work it ranges state by
Prohibitive,
state,
probably.
but somewhere between $200 and $1,000 per house. There probably are more efficient ways that it can be done.
There must be, is there any way with GPS or something that would be cheaper in today's world? I don't know.
There's a technology referred to as LiDAR, which actually could be used, and I believe that the state of North Carolina has used LiDAR extensively in generating their own maps. North Carolina is a little bit different because North Carolina actually takes the lead on developing their flood maps.
We should probably ask the GAO to see if we can find a very inexpensive way in order to create a template here where we can get access to that information, share it with the policyholders as well, so that we understand, so that they understand in terms of the elevation, you know, if you're in a floodplain. And anyway, my time's expired. Thank you very much.
Gentleman's time has expired. We have a few additional questions that we'd like to ask. A few members are still here. We'll begin our second round with the ranking member, Mr. Cleaver from Missouri, recognized for 5 minutes.
Thank you, Mr. Chairman. I want to direct this to Mr. Woods, but when we had the flood of 1993, one of the farmers famously said, you know, that to determine the 100-year flood mark, you put 99 white marbles in a jar, put one blue marble, and shake it. And every time you pull the blue marble is the percentage of chances of having a 100-year. But, you know, you keep putting it back every time and shaking it again. So there's some unpredictability no matter what we do, but I think we ought to be intelligent about it. Most people who are not familiar with Kansas City probably can't understand this, that in 1977 in the Country Club Plaza, the world's first shopping center, 25 people drowned in the middle of Kansas City, Missouri. And I'm not sure, you know, I think we've fixed that with Brush Creek, as you know, Mr. Wood. But I'm pointing out, I think, to the best of our ability to also follow up Mr. Royce. I mean, we've got to use the highest level of technology possible and do this remapping. But I'm also concerned, would like to ask you, Mr. Wood, a lot of, you know, we've incurred a lot of debt. The NFIP has incurred a lot of debt over the past few years with all of the recent events. And then the opponents are always saying that, you know, the reason that the debt is so high is because of the subsidized policies in these exotic areas, these environmentally sensitive areas. Do you think that we ought to deal with trying to force people out of environmentally sensitive areas, the exotic places, you know, building a house on you know, at the foot of a hill where you have annual mudslides? I mean, or do you think that we ought to just realize that that's the way things are and try to build that into whatever program we put together?
Microphone.
I'll put it into perspective, I guess, of the home builder and talk about it from a new construction perspective. That's the one I probably know the most about. First, I don't believe that new construction within the floodplains are the reason why NFIP is experiencing a shortfall in funding. It's quite the opposite. First, in order for a builder to construct a new home within a floodplain, the builder must ensure that the structure is compliant with all building standards within the floodplain. Second, all new homes, when purchased using a federally regulated mortgage, are required under federal law to obtain flood insurance under NFIP. And third, as FEMA has already publicly acknowledged several times, new construction always pays a full risk rate for that insurance, meaning newly constructed homes within the floodplains do not receive subsidized insurance. So, anyways, additionally, NHB has been told that in commonly flooded areas, the new construction that is built today with current building codes routinely outperforms the existing housing stock that's there. So I think it's a process, and the decisions need to be made based upon, again, we beat it to death, but the correct flood maps and the correct flow designs. And I would point out one other thing that I might add to it that goes back to a conversation. The elevation of a home, at least with new construction, is a very simple thing to gather. And that's the fact that we have to put that elevation on our building permit at the city. So a whole subdivision, and that's where most of the construction goes on, you could have those elevations immediately. They're part of the public record.
Thank you.
Gentleman yields back. With that, we go to the gentleman from New Mexico, Mr. Pierce, recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Ellis, you mentioned here that 5.4% of the houses in the country have flood insurance. Have you broken that down also for the number of people in high-risk areas? Is that equally 5.4?
I have not, Congressman. I mean, basically, that number was realized by looking at the census data of how many housing units are in the country and then how many policies there were.
Would your guess be that it's a similar amount, that 5.4% in the high-risk areas have flood insurance, or you think they're a little more?
There is a problem with the fact that there are properties in the mandatory purchase in the special flood hazard area that are not purchasing flood insurance, and GA has done some analysis of that.
Mr. Hydrick, so we get 9 inches of rain a year in New Mexico, in my district. Do we pay a higher insurance premium because of the events on the coastal areas?
Thank you, Congressman. No, the flood insurance rates are set by flood zone. A flood zone is a flood zone regardless of what state it is in. So if you're in a preferred risk area, regardless of what state you're in, that's the rate you're going to pay. I could also,
if I could interrupt, several years ago, we were paying 100-year flood rates. Now we're up to 1,000-year flood rates. Doesn't that stick us with a higher premium? People would be more apt to have to pay flood insurance when we define it as 1,000-year to get into the program. Is that not correct? The definition has changed.
Well, the mandatory purchase requirement is only to a 1% chance or greater of flooding. If your chance of flooding is less than 1% in any given year, then there is no mandatory purchase requirement. Did I understand your question correctly?
It doesn't gel with what banks and real estate people in New Mexico tell me. They tell me that previously they did not have to buy flood insurance, and after the great losses in Sandy and Katrina that they are having to buy flood insurance, and they said it's because of the redefinition of who has to buy flood insurance, who is required or encouraged to buy flood insurance. I'll sort through that. Is it, Ms. Templeton Jones, are there areas that we absolutely should not rebuild in after they've been flooded and destroyed once or twice or 10, or should we have such a definition?
I think that we need to mitigate losses. We need to take a property, if it's subject to having been flooded more than once or twice, if the cost of that is to mitigate that property, raise the property, move the property outside of it. But I think we need to also recognize that many people that live, it's not just people that are wealthy that are living on the coast or at the bottom of the hill that have these big, huge, wonderful houses. Many times it's people that are just working. I'm originally from New Orleans. Granted, New Orleans, Katrina was the huge disaster, but the vast majority of people are not wealthy people. These people live there because it's a major port. People have to live near where they work. So we have to find a way to protect these individuals, help them mitigate their properties, raise them, move them to a safer ground so that they don't experience the losses.
Would you go so far as to say that when it's within people's capability, or when a city has been told that they should mitigate and they don't mitigate, that they won't be covered under the program? Is that too extreme, that you'd be somewhat responsible for your own actions?
I have my own personal opinions, but, you know, at the end of the day, you know, people have to have a place to live.
Well, I understand that, but there's no national tornado program. In other words, we don't have floods in New Mexico. We got tornadoes, and there's no national program to help us rebuild. We have forest fires that are created by whatever reasons, and there's no national program to help us rebuild from the forest fires. So where's the moral responsibility to people like us? We have to pay higher programs, and with all respect, Mr. Hydrick, I believe that we do pay higher rates. And we pay rates because of people out there suffer the problem, but they don't pay rates higher to help us suffer from our problems. So where is the moral component of that? If you'd like to address that, or if you don't, I mean, it's okay, Ms. Jones.
You know, I think, and I have to agree with Mr. Hydrick, the rates are the rates across the board, and we see this every day. If you're in an A zone, you pay A zone rates. If you're in a V zone or X zone, you pay V or X zone rates. You know, as far as there is some gotchas in it. If you don't have flood insurance and you experience a loss and you receive federal funding, you have to carry flood insurance from that point forward. But I think we need to also recognize the fact that it floods everywhere. Where the flooding, it's not just a coastal situation. Where it rains, it can flood. And unfortunately, people that experience flooding or coastal areas recognize that and do have a better uptake on the flood insurance policies. But it's areas that don't experience the floods often, and we don't see the amount of flood insurance available.
We'll leave the moral question hanging to another time. Thank you, Mr. Chairman. Yield back.
Gentleman's time has expired. I just want to kind of wrap it up. I've got a question or two here myself. One of the things that was brought up was with regards to the debt of the NFIP. You know, the gentleman from New Mexico makes a great point here about you know, the different tragedies and catastrophes that we go through as a country. Mr. Ellis, I'm curious about your position on the debt that the NFIP has accumulated. Is that something that we should, you know, whenever we did Sandy, we found other monies in the budget and paid for it by doing that rather than extending the debt. Some of it's still there, but should we? And then I guess the question becomes, actuarially, do you figure in those extreme events, or do you actuarially figure in the normal things that happen, like in my area here just happened this last couple of weeks? What would your opinion be on that?
Well, a couple things, Mr. Chairman. So the you know, the debt, it's true that the debt was largely driven by the storms of 2005 and then by Sandy. One of the things, and just kind of getting to the point about the people paying full risk-based rates and not the subsidy, I would argue that the fact that the program can carry a $23 billion debt and still operate is a subsidy. The subsidies are inherently baked into the program because no private sector, there's no profit that needs to be taken. There's no, you can operate with a $23 billion debt, and so I think that that's actually already built into the program. As far as the debt, I mean, it's pretty clear that it is very unlikely that it'll ever be repaid under the program. I mean, they repaid $1 billion 2 years ago. They hadn't repaid anything over several years. It's very unlikely that that is going to be repaid. But it does keep the concentrates the mind of lawmakers and of the public about some of the challenges in this program and the need to reform it. And so certainly we see that as a important symbol for actually continuing to reform and improve the program.
So my second question, I guess, was, do you believe that we need to to structure the program actuarially for the average losses per year, which are, you know, several $billion versus the catastrophe that happens once every 10 years?
The way the FEMA had set rates before was that they looked at the average historical loss year over the previous decade, throwing out the highest loss and the lowest loss. You have to take into account, you have to discount it, but you have to take into account these extremely large events because we already know they can occur and they do occur. I mean, you looked at 2005 and in the number of named hurricanes, we got into the Greek alphabet. We ran out of names. And so, I mean, clearly these are issues. And then, there were a lot of people who said, well, that was a one-off. That was, Katrina, and it was 1 year. But then you had just, not even a decade later, you had Sandy, which then had not only increasing the borrowing authority for the flood insurance program by $10 billion, it also required a $50 billion outlay from the federal government on dealing with that issue. And so I think that you have to, Mr. Chairman, take that into account when you're setting the actuarial rates, that there are these black swan events, there are these fat tail losses, but you have to discount it appropriately, and that's what actuaries are all about.
So I guess the question becomes then, do you believe that when you structure the program that you need to structure in a governmental component as a reinsurance, as a backstop on this? Because it appears, or historically, that when these things occur, the government's going to be there as a backstop. Do you believe that should continue, or should figure out how to do that?
We certainly, and we have testified before this committee in past, have been opposed to creating a national catastrophe reinsurance fund. We don't think that's necessary. There's a vibrant, very well-functioning reinsurance market. We can lay off debt on the worldwide marketplace, and so we don't think that that is necessarily the route. Obviously, Uncle Sam is serving as a lender for this program to keep it afloat while it's underwater. We want to see further reforms in the program. We want to see more of the debt or more of the risk laid off onto the private sector through the primary insurers and reinsurers, rather than and deal with that issue that way, rather than creating some sort of federal reinsurance.
Mr. Hydrick, what do you believe? What do you think about that? Can you actuarially make this thing work and have the private sector take all the risk on all the properties? Which is what Mr. Ellis is advocating.
Well, I wouldn't have the expertise to say that they could take on all the risk, but what I can say is that, and as we've proposed, that there's room for the private market to participate in this and to develop the expertise and to take on more and more risk over time. In many markets, even auto insurance, states have residual markets, and that's a normal part of the insurance industry. I couldn't tell you whether or not, whether or not I think the NFIP should become a residual market or not. It all depends on what the ultimate design would be. In terms of the debt, one of the things to keep in mind is, yes, the program is $23 billion in debt to the U.S. Treasury, but it has paid out over $50 billion in claims over its lifetime. So that's about $27 billion that otherwise would have been paid through disaster assistance that was actually paid by policyholders through premiums.
Very good. Well, my time's expired, and I think we've had a great discussion this afternoon here. Our intention is to, with our discussion yesterday or last week with regards to mapping, is to begin the discussion of how we get the basics down and get the maps correct so we can begin to have some intelligent discussion about the rest of the program. Today we want to discuss the important strengths and weaknesses of the NFIP, alternatives to NFIP, or there are some, improvements to NFIP, whatever we can make. And I think mitigation is an important part of this, which there is some action along that road. I can tell you from personal experience with this last flood we had in Missouri this last 2-3 weeks. We had a historic flood back in '93 along the Missouri River. A lot of the properties were mitigated. In fact, entire towns, small towns, were bought out, moved up on top of the ridges, away from the lowlands. Levees were built up and improved and reinforced. As a result of that, even though we had a historic flood along the Missouri, on my half of the Missouri anyway, this past couple of weeks, the damage was not as great as it would have been. It actually worked. Mitigation worked. So I think there's a lot of things we need to talk about, discuss along those lines. We talked today a little bit about the affordability of people being able to afford the rates, as well as the take-up rate. How do you balance those things? And then we looked at the debt a minute ago. Is how do we look at the debt that we incur? Do we need to have a government component of this? Can we do without the government component? Where do we need to go? All of these things are things over the next several months we want to ferret out. We want to try and get your input. I know we have a lot of folks in the audience who are very interested in this. We want to continue to have a dialogue with all of you as we go through the process of trying to find a way to improve this situation. And the testimony is pretty general in agreement that at some point this is, if not part of it, if not all of it, will transition to the private market. So if that's the case, how do we facilitate that and not hinder it? So we've got a lot of work to do and a lot of things to discuss. We certainly appreciate all of the witnesses today. You did a great job. Appreciate all of what you did. And so without objection, I would like to submit the following statements for the record. statement from the National Association of Realtors, a statement of the National Association of Professional Insurance Agents, statement of the National Multifamily Housing Council, and statement of the American Insurance Association. Without objection, all members have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond promptly if you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with this, the hearing is adjourned.